Sweet. Okay, guys, welcome to the Elite Traders meeting. I don't know, I sent the link out for free this time, actually into the free Elite Traders Telegram. We don't do that very often, but sometimes, on rare occasions, I'm feeling a little bit generous. So, welcome to everyone who is a member or not. Today, we will be discussing the macro drivers. We'll be discussing some of the market movements we saw last week and how we can adapt this week to hopefully make some money. If you see me pausing throughout, it's because I'm admitting people or just reading the chat. So just bear with me throughout this. Um, so what we'll do is start with macro drivers. We'll just have a look at some of the data and see what's going on. And then we can start looking at the charts and we can come up with some trade ideas. So first of all, what we want to have a look at is the inflation. What we are really looking at we're using inflation really to gauge central bank movements. So I'm not going to go into too much detail here. This obviously isn't a webinar on how to use inflation and things, but if you want specific topics covered in more detail, let me know in the chat. We can go over it. But essentially, what we can see is Switzerland. So the chart down here, inflation rate currently at 0.3. Now, if we're comparing that to all of the other major economies, so Canada, America, Europe, Australia, so on and so on, it's significantly lower. They're all hovering at least above one. So we can see the United Kingdom's currently at three. We've got Australia at two, and so on. So what that tells us is we're already looking at the central bank, so the Swiss National Bank. Now, if you are in the free Telegram or if you're in the Discord, you'll know that I'm very bearish on the Swiss. So in fact, one of the main reason I'm actually bearish on the Swiss is due to their central bank policy. So I would expect them to go down into neutral to negative rates this year. It might take some time. We might see some back and forth between cutting and holding, but the idea is still very prominent in terms of selling the Swiss. Now, if we're taking, again, I've been talking about Swiss yen quite a lot recently, so it's not going to be the main topic of this webinar, but this is where we'll start. So if we're looking at the Bank of Japan, we're looking essentially at the complete opposite. So again, their central bank or the market expectations for Bank of Japan is that they're going to cut once this year. Now, that might sound a little bit strange, or it might sound like, why would you want to buy the yen if they're only hiking once? Because the answer to that is the Bank of Japan is known to be slow. No one really expects the Bank of Japan to necessarily hike rates, hike rates, hike rates. They have core economic problems. So they can't just keep hiking and hiking and hiking. They have to hike, hold, see how things go, see what the data is and see how it develops. Then they might hike again or they might hold and then again assess the data. However, again, the idea is there of being very, very bullish on the yen. So that gives us two core ideas already, short Swiss, long yen. Now, last week we saw, let me just have a look here. So yeah, last week we saw the euro, specifically the euro dollar, get bought up heavily and very, very aggressively, very, very quickly. Now, I saw probably around three or four people, and that doesn't sound like a lot, but I don't follow many people. So three or four people blew up accounts on Eurodollar last week that I saw on social media. Um, and that comes down to two things. First of all, the market was very, very quick with this movement. It wasn't something an average trader will be able to trade around, and I almost got stuck in it as well. So we actually, again, just for some transparency, we took a short position on Eurodollar. I sent a short position around here. Now I got stopped out very, very quickly on that one, so it is what it is. So the movement we saw was due to two things. We've got the trade war in the US, or sorry, the trade war revolving around the US, basically caused by the US, caused by Trump. So that essentially started as a very bullish catalyst for the dollar. And this was one thing that was really helping the Trump trader initially. Now, this has been faded out quite significantly. And the reason is I got a question the other day is why were tariffs so bullish for the dollar and now they're very bearish? And it's because of one simple reason. Tariffs haven't gone the way Trump wanted. So essentially what it feels like for a trader or for an analyst is that Trump essentially came in, tried to throw his weight around, taking people's lunch money. I'm going to tariff you, I'm going to tariff you, I'm going to tariff you. Now, what we've had in return for that is these countries, so Canada, Mexico, China, and Europe, have basically said, "Well, no, Trump, fuck you. We're going to tariff you back." So it's almost like the school bully. Um, Okay, so I just admitting more people. Okay, right. I'm not a professional webinar guy, but we'll get back on track now. So Trump essentially had tariffs put back onto him. So it's been essentially a slap back in the face for Trump. It's not worked out as market investors, sorry, market participants expected, or as Trump expected. So it's now a case of Trump has started a trade war, and it's not necessarily it actually, I guess it is kind of a big deal now because obviously, the market is very clearly telling us and telling Trump that these is not in a good situation. There's a lot of fear and a lot of uncertainty now about imports, exports, and trade relations. So that mirrors actually into the DAX slightly and the S&P, but again, we'll go into that slightly later into the webinar. Um, Uh, okay. Yeah, don't worry. It's all good. Let's keep on rolling. Let me just get back on track. What was my next point? Yes, so that actually leads me into the sorry, the market appetite. So it's very, very clear that we're in a risk-off market. Now, this was, again, it was a slightly confusing period for a lot of traders, especially new traders, because what you are typically taught in a risk-off market is we have gold up, we have the yen up, we have the Swiss up, we have the dollar up, we have risk-on assets such as equities, we have the euro, the pound, the Australian dollar, the New Zealand dollar, all actually not the Australian dollar, sorry, but all of the other ones basically going down as we see investor risk appetite change. Now, this wasn't quite the case because we had a risk off market, but the euro did very, very well. So again, that was a big confusing point for a lot of people. Now, the reason the euro did well in a risk-off period was because of a very specific piece of news. And again, this actually relates back to euro dollar on it wasn't just the dollar that dumped that benefited this market. What also happened was Germany has announced a 9 billion or 900 billion, sorry, 900 billion fiscal stimulus. So what this does is essentially really, really help the Eurozone or Germany's economy. Now, this has now started to lead market investors, participants to expect the ECB to cut rates less or be less aggressive with their rate cuts, as we obviously see stimulus. So that's another factor, and this is why I'm looking to now pivot long. We've got the dollar labor data being very, very poor, which actually Actually, I can't pull up all of the labor data, unfortunately. But yeah, we've got US labor data that's taken a bit of a hit. We've also got lower inflation coming out. So the narrative of rate cuts for the Fed is kind of back in play. And we've got the opposite now with the ECB, with them potentially holding off on the rate cuts. We also had a hawkish cut from them previously. So the euro dollar longs are seeming very, very clear at the moment. However, after this aggressive move we saw last week, it would be very, very foolish to start buying at this point. And also, it would be a little bit silly to start selling. Now, I'm not saying that shorts on this wouldn't work because I would be, or I am pretty much in the mind that we are going to see some sort of reversion, pullback, or correction, whatever you want to call it, is fine. But I would expect some downside here, but I'm not willing to bank on that yet or bet on it. So I'm waiting just to see if we can get some sort of pullback within the fib level, fine. If it comes a bit further down, fine. But I'll be looking to take this market up to around 1.1. Now, the reason I'm looking at 1.1 is because this market essentially dumped since September. It's been, again, anyone that's been following me closely will know that I've been very, very bearish on euro dollar for a long time. Since again, I was the one calling shorts back in this period, sort of the end of August, start of September. So I was selling this whole downside. Now I am starting to think we could actually just buy up this market again and basically trade it back to sort of pre-September, pre-August levels. So we will see. We'll obviously have to adapt to how data comes out, but at the moment, as things stand, this seems like a very, very solid trade idea. Uh, Bet within a month they will start asking how they're going to pay that off. Yeah, maybe, but again, we'll see. I'm not here to try and speculate on that type of thing. So pound dollar is pretty much in the same situation. Actually, obviously, we don't have stimulus in the UK, but we are seeing sticky inflation. And if anyone can, if anyone's been watching, I've been very clear in the Telegram and in the Discord about inflation. Lower inflation leads to rate cuts, higher inflation leads to rate hikes. However, in the UK, we've got what we call sticky inflation. So what sticky inflation is essentially inflation is not really doing anything. It's not going up, it's not going down. So it leads the central bank into a position where they can't really do anything. So they just got to hold rates. So that's what we've got with the UK at the moment. And again, I've already discussed about the Fed. They've got inflation coming down slightly. They've got a weakening labor market, which leads us to start thinking they might cut rates a bit sooner than we were thinking. So again, pound dollar is looking like a pretty good long position. Gold and silver, they both coincide quite nicely or go together quite nicely. Obviously, like I said, I'm still in the mind that we're in a risk-off market, so I'm quite happy to buy precious metals. We've also got, again, I'm just going to quickly refer to notes here so I don't forget anything. Uh, the US dollar's obviously sold off quite heavily recently. I would expect the US dollar to pull back, which is why I'm not looking to get into gold just yet. So I would like to see how the dollar opens tonight and how it develops into sort of Monday, Tuesday, and just see if we can see some sort of move back to the upside before we see a continuation to the downside, which would then obviously push gold down slightly before we could possibly catch a continuation up into around the 3,000 level on gold. We've also got China, Russia, and some of the emerging market central banks that are still buying gold, increasing their gold reserves. And we've got the US fiscal deficits are still fueling long-term inflation concerns. So inflation concerns are very often a big driver of gold. The same thing pretty much applies here with silver. So I think on silver we could get probably an even better entry. So again, if you've been with us for the past couple of weeks, whether it's free or in the Discord, it doesn't matter. You will know that I was actually quite heavy in silver at one point, took profits at this high. Actually, it was quite almost perfect timing actually. But I would love to get back into silver. I don't really have a hard take profit. I'm quite happy to essentially just buy silver, trail stops and let it run until stopped out in profit, obviously, ideally. Um, but again, we'd just be using the fib here, looking for a 50% pullback of this bullish move and see if we can get into a long position and essentially hold it. Australian dollar yen. So again, we've already discussed yen at the start of the webinar, so I won't go into that again. But the Australian dollar is not in the ideal spot. Actually, China is a big concern. So if we could get some Chinese stimulus, that might change the tune a little bit. But we've got iron ore also taking a massive hit, which is a big hit to the Australian dollar as well. As we should know, as you guys should know, commodities are a big, big driver of the Australian dollar and the Australian economy. So if we've got commodities taking a pretty big hit, then we're also going to see the Australian dollar take a hit. Now, vice versa, if we see commodities start to gain significant value, we can obviously expect the same thing from the Australian dollar. So that's pretty much it, really, regarding the Australian dollar. There's a couple of other smaller things. Australian dollar, actually, sorry, not the Australian dollar. The Australian economy is also experiencing relatively low inflation. So again, let me just pull this back for you. So here, the current inflation rate in Australia is actually 2.4. And if we're looking back at the yen, we could expect them to start hiking rates, whereas the Central Bank of Australia, which is the RBA, Reserve Bank of Australia, could look to hold, maybe cut sort of a slower easing cycle. So this position is looking great. Again, just looking for some sort of pullback here, potentially within. Oh, sorry, let me just pull up my brush here. Potentially, just some sort of pullback into this 200 moving average would be amazing, and then we can just continue the downside momentum. So we will see. But again, a lot of these trades are really relying on pullbacks. Swiss yen, I actually cut my position on Swiss yen because I had to move some portfolio things around because I'm moving to Indonesia soon. But again, I'd still really love to get into this market. I might actually execute tonight on market open or even tomorrow morning. But I think Swiss yen is still the best play of this year. Actually, at the moment, again, things can change down the line, but this is a long-term trade, so 12 to 18 months. But the Swiss National Bank, again, I've already discussed this, so I won't go into it too much again, but looking for neutral to negative rates this year. The Bank of Japan likely to continue hiking rates, obviously with a mix of holding in there, but slowly, gradually on a path to normalization. We do have a long way for this market to come back down, and it would also likely lead to a pretty aggressive unwinding of carry trades. So again, if you want me to explain what carry trades are, I can, but I won't do that just yet. Same reasoning on dollar yen. So again, we've discussed the dollar, we've discussed the Fed, we've discussed the yen. So it should be self-explanatory on why we'd want to go short dollar yen. However, just on a side note, the reason you would want to favor Swiss yen over dollar yen is not due to necessarily an economic outlook, it's more due to the interest rates. So if we're looking at swap fees, the interest rate, the Federal Reserve interest rate is 4.5. The interest rates by the Swiss National Bank are zero point 0.5. Same thing with the Bank of Japan, they're zero point 0.5. So if we're selling dollar yen, we're going to be paying a lot more in swaps. Whereas if we short Swiss yen, we're essentially not paying anything because the interest rates are zero point 0.5 for both central banks. So all you'd really be paying is your broker fees, not necessarily the swap fees due to the interest rates. So that's just a side note for you to keep in mind. CAD yen, again, really, really good trade idea here on CAD yen. We've got oil prices taking a real hit. We've got Canada currently in a trade war with the US. The Canadian economy, generally speaking, is just very weak at the moment. So CAD yen is seeming also like a really, really strong trade idea to continue down to the short side. Dollar Swiss. Now, dollar Swiss is slightly different, and I'm not really sure if I'd be happy to take this as a swing trade. The reason is because I've already discussed I'm very bearish on the Swiss, and I'm really not optimistic on the dollar either. However, short term, because we're in this risk off cycle or this risk off market, we can see the Swiss or the Swiss franc holding its ground quite nicely. It's just essentially ranging sideways. However, if we compare that to the dollar, excuse me, I think the dollar has a lot more room to come to the downside. Obviously, again, it depends on the data, but just at this moment, I think the downside is a real risk. Now, if we're looking on the monthly time frame, we seem to be following this channel pretty much perfectly. So this was established back in sort of 2011, back to sort of 2007, depends where you draw it from, it doesn't really matter. But we're sort of ping-ponging up and down. So if we're just following technicals, it would make sense for this market to come down towards sort of 95 to maybe 100, roughly. So again, we essentially just be shorting the US dollar against a more stable, sideways moving currency like the Swiss. So Swiss yen would essentially be a proxy to just short the dollar. Now, again, I'm not looking to hold this for long term, maybe just catch some short-term momentum on dollar Swiss shorts, and that would be it. Now, Australian dollar, US dollar technically looks really, really nice. I really like this chart. But as I was saying earlier, the Australian dollar is not in a great place. I would say if we can continue to see the US dollar data come out slightly weaker, this trade might come into something. But just now, I'm a little bit cautious. It's on the watch list again, just in case we see the dollar continue to deteriorate, or if we see some Australian data start to improve, maybe I can look to go long. Again, as I was saying on euro dollar and pound dollar, there's a large amount of room here to catch some upside if we can get that catalyst. But right now, it's not quite the time. Uh, Next thing here is the Australian dollar, New Zealand. Now, let me just pull this up for you. So some of you might find this interesting. Feel free to print screen it if you would like to. So these are bank trades. I was just going to move my camera here. So these are bank trades, and these are essentially what, it's pretty self-explanatory, but we can see what positions each bank is in. Now, what caught my interest was this Australian dollar, New Zealand position. So again, it's not something I'm super interested in, but it's something I'm currently researching, and it sounds like it's got some legs. Now, again, if we just have a look at a little bit more data, just need to pull it up here. Yeah, so we can see Australian dollar, New Zealand on the Edge Finder is reading bearish. Let me just log in. If it will do it, there we go. So we can see the Danske research is currently short New Zealand dollar, and the Edge Finder is reading bearish on New Zealand dollar. It's not overwhelming, in my opinion, because COT data is pretty flat. Retail is long, which is great. Seasonality, we've got a minus zero point 0.6 or minus 0.06. Again, nothing too overwhelming, but it's starting to build. So I might take something on there. And again, if you're not already, you can join our Discord. Just a quick plug before we go any further. You can join it completely for free. You've got a 7-day free trial. So if you do want to follow our trades, get signals and daily macroeconomic updates and trade ideas, feel free to join that. Anyway, moving forwards. Euro Swiss also sounds like and looks like an amazing trading opportunity. So I'm just waiting really to see how the market opens and how we see Monday develop. Because if you aren't aware on how typical market dynamics work, on Mondays, so let's say we're in an uptrend, the market is very cleanly moving up. On Mondays, we can very typically see the bottom wick of the candle get formed, and that's the bottom formed, and then we continue up for the rest of the week. And obviously, vice versa if the market's selling down or going to the downside. So on Monday, I just want to see if we can come down a little bit further, form that sort of weekly bottom wick, and then start to pull back to the upside. But again, as I've been saying, the euro seems to have found some feet in terms of economic strength, and the Swiss, I'm still very bearish on. I don't see really any reason to be buying the Swiss at this time, unless you're doing sort of a proxy like on dollar Swiss, as I was saying earlier. Euro pound, again, this one is, I don't know, I'm mixed on euro pound. I love the idea, but I'm not sure I have the balls to take it. I'll be completely honest with you. So what we have with euro pound, I've been very vocal about this one as well because it's a pair I love to trade when I'm dollar cost averaging or I'm doing mean reversion. Because essentially with this market, typically all you need to do is wait for these oops, let me get my brush. All you need to do really is wait for these aggressive spikes to the upside. You can place short positions and eventually it will play out. Now again, that's not always the case. You can have uptrends in this market, but it's generally a very mean reverting pair because obviously the euro and the pound are so correlated. It's very normal to see this market, go up, go down. It essentially just moves sideways with a slight drift to the downside in the long term. So again, this market looks great for a mean reversion trade. The pound is stable, but it's more a case now, in my view, of just waiting to see does the euro continue the strength it had last week, or is it going to give back some of that strength? Because if it gives back and we can see the market continue to the downside, that would be a really great trade. And this would be a really great opportunity to essentially just follow this longer term trend. The 200 moving average has been respected very well. And again, if I lost the platform. Just give me a second. Let me pull it back up because we've got London Stock Exchange actually in a short position. So I'll show you that so you can see it. And again, feel free to take screenshots if you want to. I don't send the bank trades in the Telegram, but I do send them to the Discord. So you might not see this again if you don't screenshot it. Where was it? Euro pound here. So yeah, London Stock Exchange Group is currently in this position. So its stop loss is 0.848, entry is at 0.8408, and they've got to take profit at 0.8255. So that's another great thing. If we've got an institution doing the same thing, looking at the same thing, then we've got some basis to our idea to start with. Now, sort of finishing off the webinar with the equities markets. Sorry, just admitting someone here. So we just had the president join. So if you want to talk, if you want to, if you want to say anything, please send me a message. If not, I'll carry on. So the equities market is interesting in my opinion. The S&P is looking like a retail trap. And I don't like saying that because it sounds so stupid. But the reason I'm saying it looks like a trap is because we've come down to this 200 moving average, just like we did here. And again, just to clarify, if anyone doesn't really trade moving averages, the 200 is a very, very good way to determine dynamic support and resistance because it's used by so many people. So if you've got, let's say we've got 20 institutions looking at that 200 moving average and they're all moving hundreds of millions and they're all bullish on the market, it's very likely we'll see buying pressure through there. Now, I actually have the opposite idea. I'm quite bearish on the S&P right now. And again, this is more relating back to the trade wars and the Fed currently holding rates. So I'm not looking for a huge move down. I'm not saying we're in a crash. I'm not saying anything super bad's going to happen. I'm just saying I would like to see this 200 moving average break and potentially start respecting the next support levels in the market. So there is that. On the other hand, this market could make me look really stupid and it could just rocket up from here. But I would doubt it. I think if we can start seeing the Fed come back towards a more aggressive rate cutting cycle, that would be a catalyst for the S&P to start rocketing again. But right now, way too cautious to start longing the S&P. The DAX is essentially the opposite, actually. I'm very bullish on the DAX. The only argument I can really find actually to not trade the DAX at the moment is the because we had the 900 billion fiscal stimulus. That again, as I was saying earlier in the webinar, could lead the ECB to hold rates. Now that is a slightly negative thing. So if anyone doesn't know, and again, I'm just going to clarify this for some value in this webinar. When when we're talking about equities, so the S&P, Nasdaq, Russell, DAX, FTSE 100, whatever it is, if we have that central bank, so obviously if we're talking about the FTSE, then it's the Bank of England. You get the point. Rate cuts generally are very bullish for equities and they're bearish for the currency. The reason they're bullish for equities is because essentially it makes it cheaper for those companies to borrow money. It makes it much easier for them to expand. It improves optimism around companies. Just like your mortgage, if we have lower rates, you're going to want to buy a house, or you might want to buy another house. You're expanding, you're doing things. It's the same thing with the stock market. Um, Sorry, I'm just reading a message here. When recorded, I don't know why, but I don't hear you. Uh, Eman, I'm not sure why. I will get back to you. Do you mean you can't hear me now, or what? Because I think the mic is okay. Yeah, I'm not sure about that. But yeah, the DAX again. Just going back to this. So the fiscal stimulus generally is very good for the DAX. It's an improvement in the economy. It improves investor sentiment. So yeah, I'm still very, very bullish. We've not broken any structure. We've technically now created a higher low. So I think we can very, very easily get into long positions. The only thing I'm really just cautious of is where we get in. Because what I don't want to do is enter right here. We have the pullback to this trend line, or whatever you want to call it. It's fine. I don't care, and then we miss a better opportunity down here. So I'm just really a bit cautious on the exact entry point, but I think the direction and the idea is essentially flawless. I think the DAX is a great idea, and this one will be traded up to around 25,000. Um, could we expect some kind of pullback in US 500 as happened in 2022? Would make sense since we're skyrocketing since NOV 23. That's a great point, and I actually forgot to mention that's why I've got let me just pull it so it should be daily. Yeah, so that's why I've got this measurement tool up. So I'm just trying to see really where we start stalling, because in the S&P 500 it's quite normal, or it's not like a massive red flag if we could have 10 to 20% pullback. So at the moment we're on, actually let's just draw from here, we're on not even 10%. So if we could get 20%, that would be pretty nice. I think that would actually be very, very healthy. So yeah, I wouldn't rule out the idea of a larger downside move just based on sort of natural market dynamics and technicals. So there is that. So, guys, is there any questions? Because I pretty much covered everything I was going to. Are you still bullish on euro and bearish on the dollar for this month? I am, yes. So I'm looking to go long on euro dollar at some point. So again, I've already spoken about this. So for anyone that was listening before, I won't go into it again too heavily. But with the stimulus from Germany and the very likelihood that the ECB is going to slow down on rate cuts or be less aggressive, it's a bullish sign for me on the euro. The Federal Reserve, we've got weaker labor data. We've got inflation that's not, well, lower inflation is what I was trying to say, which leads me to think the Fed might have to cut rate a little bit sooner than we're expecting, because we previously had inflation go from 2.9 to 3, which actually pushed back a lot of the rate cut narrative into later this year. And now, obviously, we're sort of switching back. We do actually have CPI this week, which I was going to mention and forgot. So yeah, this week we've got CPI for the US, which will be a huge thing. Actually, it'll be a big, big sign. Because if we get CPI coming out down now at 2.9, again, that will reduce that rate hold narrative. So we could expect the Fed to start cutting rates a little bit sooner. Um, and we've got unemployment claims and jolts, so we do have more labor data. Which again, if it's not good, I think the dollar's going to be in some serious trouble. So, guys, I think that's pretty much it from me. Is there anything you want to discuss? I can just go over oil quickly, and then again, I'll give you some time to ask any questions. So, oil is again, it's in a very, very difficult spot. So I would technically, I would love to buy oil at this level. It looks really, really attractive. It looks really strong. However, fundamentally, it's not. We've got OPEC that's slowing down their production cuts. Oh, sorry, slowing down the production cuts, so the supply will be increased. So that's a bit of a problem. We've got Chinese demand uncertainties. So yeah, I mean, obviously we've still got Trump's drill baby drill narrative. I've not heard much about that in terms of development, but after this tariff thing's done, maybe he'll come back to oil. So I'm just not looking to buy it at the moment. I wouldn't really want to go short either, just because I'm not a huge oil trader. It's not something I keep an eye on too often. But if I had to choose a direction, I would quite happily look to go short on oil towards sort of $55 a barrel. Um, but again, that's just my 2 cents as a non-oil trader. How do you think the recent 800 billion euro defense plan impacts the euro as a currency? Tom, we've spoken about that, but the stimulus has very clearly had a bullish effect on the euro. That's essentially one of the main drivers of the euro last week. So I would expect that to start hinting towards the ECB holding rates a little bit, or at least being less aggressive on rate cuts. So I would expect it to be, well, it is bullish for the euro. What to expect if CPI comes out higher than 3%? If the inflation comes out higher than 3%, that would um, dampen rate cut narratives. Um, it would lead the Fed to possibly start holding rates a little bit longer. Another Tom? Yeah, we've got a couple of Toms actually. We got Tommed. We did indeed. So yeah, guys, is everything clear? Again, I have absolutely no issue going over things again if you need to, or covering something in more detail. Um, but again, that's all I've got in terms of things to discuss or updates. Give you a second. Still got people joining. It's almost half an hour after I sent the link out. Crazy. Cool. It doesn't seem like we've got any more questions. So, guys, I think we'll end it here. Again, this has been recorded, so I will put it on YouTube after. So, if anyone wants to rewatch it, feel free to. In fact, please do because I get ad revenue. I'll get about 20p. So, guys, have a good one. Have a great week. And again, feel free to join Elite Traders. It's completely free for the first 7 days. So, if you don't like it, you can cancel. You've got no risk at all. The link is, I'll put the link in here again, just in case anyone does want to join. So, guys, have a great one. Again, don't get margin called. Enjoy your weeks. Absolutely no problem, guys. It's been a pleasure talking to you all, and I will see you later.